Hi. Analyzing our cost volume profit analysis, or looking at what we call our break-even analysis, we're going to be using Ronald Hilton's Managerial Accounting. This is the 9th edition of the book that we're using. The question that we're going to look at is problem 7-34, which analyzes basic CVP relationships. Now, keep in mind that each question will give you a certain basic situation, and in that situation you are expected to understand how differences within a single variable or a single aspect of your business will affect your break-even or your cost volume profit analysis. Now, in this particular case, it says Disc City Incorporated is a retailer for digital video discs. The projected net income for the current year is $200,000 based on a sales volume of 200,000 video discs. Disc City has been selling the discs for $16 each. The variable costs consist of the $10 unit purchase price of the discs and handling cost of $2 per disc. Disc City's annual fixed costs are $600,000. Management is planning for the coming year when it expects that the unit purchase price of the video discs will increase 30%. Ignore income taxes. Now you'll see it in the first situation. You've been given a base case, and in this last sentence they're giving you a basic estimation, or a basic situation where you can conduct a sensitivity analysis. Sensitivity analysis means that if one aspect of your business changes, how will it affect the rest of your break-even? Now let's go through what is required in this particular question. There are multiple requirements. We'll go through 1, 2, 3, and 4. The first 4 requirements we'll be skipping over the builder spreadsheet. We've got separate trainings for that. Now, in the first requirement, they say calculate Disc City's break-even point for the current year in number of video discs. Now, when we do this, we want to make sure that we understand how to calculate this particular break-even. The formula for a break-even, especially in units or CVP analysis, is fixed costs divided by contribution margin. Now, in terms of basic principles, your contribution margin is going to be the difference between your selling price and your variable cost per unit. So selling price per unit minus our variable cost per unit. Now, keeping this in mind, we can calculate the contribution margin at any point in time. So we are going to calculate this particular break-even. Looking at the information that we have, once more we'll come back here and see what our fixed costs are. And the fixed costs are listed here. Disc City's annual fixed costs are $600,000. So fixed costs are going to be $600,000. Then we want to identify what the selling price is going to be. So let's calculate the contribution margin. The selling price of each disc is $16 each. That's $16 here. The variable cost of each one is going to be $10 each. So that means, and now be careful with one thing, because there's the associated variable cost, and then there's also handling cost. That handling cost will also be incorporated here. So we'll have $2 incorporated over here. So it's basically $16 minus $12. That leaves you with a contribution margin of $4. With a fixed cost and a contribution margin, we can now calculate our break-even in units. So our break-even is going to be $600,000 divided by $4. Okay, and when we put this into the calculator, 600,000 divided by 4, this gives us a volume of 150,000 discs. Okay, now this is our current situation. Question number 2. This is question number 1. Question number 2 says, what will be the company's net income for the current year if there is a 10% increase in projected unit sales volume? In order to calculate this, we want to go through the income statement method. Now, the income statement method requires a sales or a revenue amount, then we will calculate a variable cost, then we'll calculate a contribution margin. From the contribution margin, we'll deduct a fixed cost, and then we'll calculate a net income. Now we can do the net income calculation directly after the fixed cost because they've specified ignore income taxes. Now, to calculate sales, we'll take the volume, the unit volume of sales. So if there's a 10% increase in projected unit sales volume, and our original sales were 200,000 video discs, so a 10% increase in 200,000 discs will be equal to 220,000. So that's the number of units that we're dealing with. 220,000 units. And with this, we've got a sale price of $16 per unit. So with a sale price of $16 per unit. So we'll do 220,000 multiplied by 16. That gives us $3,520,000. Then we've got our variable cost. Now again, our variable cost is based on the number of units. So we've got 220,000 units, and our variable cost was $10 and $2. That's $12. So we'll do 220,000 multiplied by 12. We had $2,640,000. To calculate the contribution margin, we'll do sales minus our variable costs. That's $3,520,000 minus $2,640,000, and we are left with $880,000 contribution margin. And from this, we want to deduct our fixed cost, which is given to us at $600,000. So $880,000 minus $600,000, and we are left with $280,000 in our net income. This is part 2. Now let's look at part 3. Part 3 says, what volume of sales in dollars must Disc City achieve in the coming year to maintain the same net income as projected for the current year if the unit selling price remains at $16? Now, the net income that is projected for the current year is $200,000. This means that they've given us a target profit. Now, to calculate the number of in order to calculate the volume of sales in dollars, we have to first calculate the number of units. So to calculate the number of units for a particular target profit, the basic approach that we'll take is going to be fixed costs plus our target profit, and we'll divide that by our contribution margin. Now, this means that we've got our fixed cost of $600,000. Our target profit in this particular case will be the original projection of $200,000. And our contribution margin remains exactly the same. That is $4 as calculated earlier. So that means we've got $600,000 plus $200,000. That gives us $800,000. And this is to be divided by $4 contribution margin. That gives us 200,000 units. This is how we calculate our break-even in units. Now we have to convert that into the number of dollars. So the easiest way to calculate the volume of sales, so in order to calculate that volume of sales, we will simply take our break-even in units to, our target profit units, 200,000 units, and we'll multiply that by our sale price per unit. So 200,000 multiplied by 16 gives us $3,200,000. That means that you have to achieve a revenue of $3,200,000 in order to maintain our profit of $200,000. And part 4 says, in order to cover a 30% increase in the disc's purchase price for the coming year and still maintain the current contribution margin ratio, what selling price per disc must Disc City establish for the coming year? Now, this is very interesting. This is something that happens very, very often within any manufacturing industry. So what we want to identify is that our purchase price for the disc is going to increase. So originally the purchase price of the disc was $10. So if this increases by 30%, we'll do 1.30 multiplied by $10. This gives us $13. This becomes our purchase price, our new purchase price as a measure of our variable cost. And the specification is that you still maintain the current contribution margin ratio. So the current contribution margin ratio, if we're to do a calculation over here, our contribution margin ratio will always be equal to the contribution margin divided by our sale price. And our contribution margin is $4 as calculated earlier, and $16 is given as our sale price. So 4 divided by 16 gives us 0.25 or 25% contribution margin. Now remember, the contribution margin has to be calculated on the basis of some new sales price. And if we look at the formula, we'll be able to identify where to calculate the sale price. So if CMR is equal to contribution margin, that is sale price minus our variable costs divided by sale price, we can substitute all of our known variables into this particular equation to solve for our new sales price. We've got our variable cost, that's our updated variable cost of $13. We have our standard CMR of 25%, so that's 0.25 will be equal to sale price minus a variable cost of $13 and divided by our sale price. So we're going to take this as being divided on this side, we're going to take it and multiply it on the other side. So we'll get 0.25 of sale price will be equal to sale price minus 13. Now we'll take the sale price, this one to the other side, this one to the right hand side, and this one to the left hand side. So we'll get 13 equals to sale price minus 0.25 sale price. This is our basic algebra. 1 minus 0.25 gives us 0.75 sale price, and this 13 remains as is. This is being multiplied here, it goes to the other side to be divided. So 13 divided by 0.75 will equal to your sale price. And if we actually calculate this, 13 divided by 0.75, we get 17.33. This should be the new sale price in order to help you maintain the exact same contribution margin ratio as before. This is question 7-34. If there's any questions or confusions, please drop a comment. Thank you.